Welcome back to your CPA accounting refresher. Today we're covering another high-yield topics in financial accounting changes and error corrections. Whenever you see one of these questions, stop and ask yourself one question. Am I fixing this going forward, going backward, or through retained earnings? Almost every question falls into one of four categories: change in accounting principle, change in accounting entity, change in accounting estimate, or error correction. Let's start with a change in accounting principle. This happens when a company switches from one acceptable GAAP method to another acceptable GAAP method. Remember, this is not an error because both methods are allowed. Examples include changing inventory methods, changing a revenue recognition method, or another acceptable accounting method permitted by GAAP. The general rule is retrospective application. Think. Pretend the new method had always been used. That means restate prior year comparative financial statements, adjust beginning retained earnings of the earliest period, presented for the cumulative after-tax effect, and disclose the change in the notes. Do not run the cumulative adjustment through current year net income. This adjustment is called a prior period adjustment, or PPA. Now remember the two famous exceptions. First, a change in depreciation, amortization, or depletion method is actually treated as a change in estimate, not a change in principle. Second, a change to last in first out is applied prospectively because retrospective application is considered impracticable. Both are favorite CPA exam exceptions. Next is a change in accounting entity. This occurs when the reporting entity changes. Think about who is included in the financial statements. Examples include switching from separate company statements to consolidated statements, adding or removing subsidiaries, or changing from individual statements to combined financial statements. The reporting rule is also retrospective. Restate prior period financial statements as if the new entity structure always existed, adjust beginning retained earnings if necessary, and disclose the change. Now let's talk about changes in accounting estimate. This is probably the easiest category once you recognize it. A change in estimate occurs because of new information or changed circumstances. The original estimate was reasonable at the time, so this is not an error. Examples include changing an asset's useful life, changing salvage value, changing the bad debt percentage, or revising warranty estimates. The reporting rule is prospective application. Think. Don't fix the past, just use the new estimate going forward. Apply the new estimate to the current period and future periods only. Do not restate prior financial statements. Do not adjust beginning retained earnings. Do not record a prior period adjustment. The impact simply flows through current and future net income, usually through expenses like depreciation expense, amortization expense, bad debt expense, or warranty expense. Here's another important exam trick. If it's impossible to determine whether something is a change in accounting principle or a change in estimate, treat it as a change in estimate and report it prospectively. Now let's discuss error corrections. An error means the company did something wrong. Examples include mathematical mistakes, omitting transactions, recording revenue twice, forgetting depreciation, capitalizing an expense incorrectly, or changing from cash basis to accrual basis because cash basis isn't a generally accepted accounting principle. Since the previous financial statements were wrong, the reporting rule is retrospective correction. Correct prior period financial statements, adjust beginning retained earnings for the cumulative after-tax effect, and disclose the nature of the error. Like changes in principle, this is also considered a prior period adjustment. Now let's put everything together with one simple memory trick. Principle equals retrospective and retained earnings. Entity equals retrospective and retained earnings. Error equals retrospective and retained earnings. Estimate equals prospective with no retained earnings adjustment. Now don't forget the two exceptions. A change in depreciation method sounds like a principle change, but it is treated as a change in estimate, so it's prospective. A change to last and first out also ends up being prospective because retrospective application isn't practical. Here's one final rapid-fire review. If prior financial statements are restated, you're almost always dealing with a change in principal, a change in entity, or an error correction. If beginning retained earnings changes, think principal, entity, or error. If only current and future income changes, think estimate. If the question mentions useful life, salvage value, warranty expense, or bad debt percentage, think estimate equals perspective. If the company simply made a mistake, think error equals retrospective. And finally, remember the one question that solves almost every problem in this section. Am I fixing the future, the past, or retained earnings? If you can answer that question, you've usually answered the entire problem. Good luck studying, and I'll see you in the next CPA refresher.